I swear you have a lot of good trades which you get stopped out, and right after that point the market starts to go to your analysis direction. The most important reason of that is liquidity and inducement, and in this video we are going to talk about these two important and powerful concepts. Hello, how are you? I'm Mehran, your trading companion, and in this video and the next new videos we are going to talk about liquidity and inducement trading as well. It is going to be totally free, and we are going to open up liquidity and inducement concepts and how you can make profits from those concepts. Liquidity is the fuel of the market. So if you don't know where the liquidity is, you are going to be the liquidity itself. So, or you know liquidity and you know the exact time of liquidations and the injection of that fuel in the market, or you are going to have so many unreasonable stop losses. In this video we are going to talk about the definition of liquidity and inducement, and it is the first episode of our liquidity and inducement course in this channel. So pay attention to playlists, they are so important. So today we are going to talk about what is liquidity and how you can see that on charts. And in the upcoming episodes I will teach you how to trade the liquidation of other people's for free. Before we start, we have several playlists in this channel, so pay attention to them. You can go here and see those playlists. There are some mind-blowing deep concepts about liquidity, smart money and technical analysis in those videos, so make sure to watch those playlists. So liquidity is the fuel that moves the markets in all time frames. So it's not time bound, and it works in all markets, in all assets and time frames. But why is that true? Imagine you are a big investor, for example, in BNB to USDT. So you are not selling 1 BNB or 100 BNB. You are selling thousands of BNBs in one order, and those orders needs to get filled, because every kind of market has its own limits in the terms of, for example, liquidity. And when you are buying something or you are selling something, you can't buy that from thin air, or you can't sell that to the thin air. So for example, if you are selling 100,000 BNBs, you are going to need 100,000 buying orders to fill your orders. And the most ridiculous and BS that I hear from gurus is that there are more sellers or more buyers in the market. When a transaction happens in the market, there are one seller and one buyer, or if the order is a huge order, there are, for example, one buyer and a lot of sellers, or vice versa. You can't buy from thin air. For example, if you want to buy BNB, there should be somebody who is willing to sell you BNB. But what makes the market, for example, go down or go up? When the big buyers keep their buy orders and they don't close their positions or they don't sell their assets, the market starts to go up. And when the sellers start to sell their orders and they don't want that asset and they keep their selling orders, the market is going down. So when a big investor wants to sell a lot of BNBs, how his or her orders gets filled? It's where the liquidity comes handy, the concept of liquidity. For example, a big investor wants to sell its BNBs, and we are seeing just this chart to this point. What do you think? We don't have this point. What do we see here? You can see that we have a trend line here. We have some kinds of support and resistances, especially here. And what do you think retail traders will do? They are going to buy the markets here because they think that it is a trend line break. They are going to buy the market here because they think that it is a support and resistance breakout. they are going to buy the market here because they think that it is a breakout and pullback. They are going to buy the market here because they think that it is a breakout and pullback. And another thing that is important is that a lot of sellers sold the market here and they are trailing their stop losses, and they put their stop losses on these highs. So we have some buy stops here. A seller's stop loss is buy stop, because when your selling positions gets closed, you are buying that selling position back. So these are buy orders too. And somebody, for example, thinks that it is a supply or demand, or it is an order block, and starts to sell the market here on this touch. So they put their stop losses here. We have all stop losses here. And another important thing is that we may enter the market with different methodologies or with different approaches, but we are going to put our stop losses in the same places, in the same highs and lows. So there are a lot of buy stops too. And who is selling to them? It is those big investors, because they want to fill their orders. Do they know that there is a lot of buy orders here? No, they are just selling the BNB in every opportunity they get, because they have a lot of big orders. So they sell to the BNB, they sell to the BNB, they sell to the BNB, and when the market starts to go to the downside, the liquidity and these transactions is the fuel of the market. And when the market regains its power and the tank of the market gets filled, the market starts to go down. So a very important rule of trading is no liquidity, no trade. Or you know what is liquidity and you know the liquidity points or liquidity pools, or you are yourself a point of liquidity. You get liquidated a lot. That's why I see a lot of people, they say that, oh, I know where the market is heading, but I can't catch that move. I get stopped out first and the market starts to go in my direction. So when this happens, you should pay attention to liquidity pools and liquidity points. They are good POIs. For example, if I want to trade this market, I'm going to mark this imbalance or FVG for my POI. And when it comes higher than that and grabs this liquidity, I start to find selling setups. Anyway, we have another important concept named inducement. What is inducement? Inducement is when the market tries to induce other traders to enter the market in the wrong direction. It shows you false setups and false signals in one direction, especially in opposite direction of the trend. The trend is to the downside and the context is bear. But when you see something like that, there are millions of traders that think, oh, it is going to the upside, so let's hop on that train. But that train is not going anywhere. It's some kind of inducement. But for simpler terms, when we have a POI and we have a liquidity point right before that POI, that liquidity point is inducement. For example, here we have some kind of inducement. Why is that inducement? Because a lot of people think that, oh, it is an order block. A lot of people think that, oh, it is support and resistance. So we call that inducement. So an inducement is a liquidity point that is right before our POI. Let's talk about kinds of liquidity. First type of liquidity and inducement is the highs and lows of an important period of time, especially higher time frames. I show you all kinds of charts so you can see that these concepts works in all the assets. Those higher time frames are monthly, weekly, and daily. So we have previous monthly high and low, previous weekly high and low, and previous daily high and low. So for example, if I mark somewhere as PWH is previous weekly high, and other kinds of annotations, you can see that here. And how can we simply mark our monthly highs and lows, the last monthly high and lows? The shadows of these candles show the last monthly highs and lows. Because if you know the candlesticks, when we have a candlestick like that, it is the lowest point that the market went there in that period of time, and it is the highest point. So this is the last monthly low and it is the last monthly high. This video is just the definition and the introduction to liquidity, so I don't go and explain the entry setups, but if you want some good entry setups, you can watch all the videos of the channel. I provided you with a lot of trading setups that work perfectly well. They are reasonable, they are not based on some indicators, and they are based on the movement of the markets and common sense. So you can watch the videos of the channel for your entry setup. Another important thing that I should mention is that all these concepts is my opinion and my experience. You should enter the market or trade these markets with your responsibility. I'm just here to help you to have a better understanding of the markets. So first practice these concepts a lot, and after that you can enter the markets with demo accounts, and after that you can enter the markets with a real account with your responsibility. Anyway, let's see what happens with monthly highs and lows. So we have monthly highs and lows, weekly highs and lows, and daily highs and lows. Those are our higher time frame liquidity points. So these shadows are the highest and lowest points of the last month or the previous months. We have the high here, and you can see that it grabbed this high and it went to the downside. These are enormous movement. Only with knowing these kinds of concepts and try to enter the market in the direction of the last movements and the context of the market, you can have a lot of winning trades, because these kinds of movements are monthly movements and they move for days. So when you know these concepts and when you have a good trading plan with just this concept, you can anticipate the movement of next couple of days. For example, this movement is an enormous movement and it went from 1700 to lower than 1600. So these movements are worth paying attention to and mentioning them in your trading plan. Anyway, but you should know the context of the market. This is a up move market, especially after this candle. We can see that this low got grabbed with this candle, and you can see the movement here. It didn't provide us with any kind of setups in lower time frames because of this body is showing that we don't have any kind of setup. Here it grabbed this low and we can see the movement to the upside. Here it grabbed this low and this movement happened. After this we have this low, this candle grabbed this high, and it went down. We don't have any grabs with this candle, but this candle grabbed this high and we can see the movement. We don't have any grabs with this candle because the body is too big and it is in the direction of the last trend. But here we have an up movement with an order block. You can see that it grabbed the low of the last candle and it started to go to the upside. Here we may have a stop loss, it is okay. Here it takes this high with a little bit of movement and it went to the downside. Here it grabbed this low and it went to the upside. Here it grabbed this low and it went to the upside, it went to the moon. After that we have this grab and we have this huge movement. After that this candle grabbed this and maybe we have a good movement, but here we can see that it grabbed this low and you can see the big movement to the upside. It grabbed this high and went down. Here we don't have any kind of grabs. It grabbed this high and it went to this low. It grabbed this low, but it is in the opposite direction of our context because we have this big wick or big shadow here. And in these kinds of conditions that the market is boop, 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 it is printing a lot of red candles. We just should pay attention to grabs of the highs, and we don't have anything like that here. So we wait until this candle prints, and we are going to pay attention to the lows. We can see that it grabbed this low and it went to the upside, and that's the end of the chart. You can see that how accurate these kinds of concepts are. We have weekly highs and lows, monthly highs and lows, and daily highs and lows, and I'm sure that yearly is going to work well, but it is a little hard because it is going to need a lot of patience. We have daily, weekly, or monthly movement like this, the previous month or the previous week. We can mark up our low and highs of those period of time, and when the market comes, for example, and grabs the low, we can find trading setups for the up move and find buying setups to enter the market in the next day or next week or next month. One other kind of liquidity that nobody pays attention, and it is important especially when you start trading as a fresh trader or as a rookie trader, is support and resistant liquidity, or SNR liquidity. This liquidity is important in higher time frames as our POIs, and in lower time frames we can use these liquidities for entering the market. That I'm not going to talk about entering the markets right now. We just want to know what is liquidity. For example, here we have a resistance level that became support, and all the retail traders, and especially the fresh ones, think that this is going to touch this support, for example, and it is going to hit the moon. But there are a lot of scenarios here. The first scenario is that it comes down, it penetrates this support level, and it goes up. And believe me, when you don't have a good trading setup, you are going to have a lot of stop losses here. How we can prevent that? We can find this level, we can mark this level, and we start when the market goes lower than this level. After it goes lower than this level, we are going to use a smart money concept trading setups for buys. They work well. I mean, we can use change of character, or we can use the setups that I taught you in this channel. So after this level, we start to find buying setups. We are not just going to enter the market, for example, here with a bull candle. It is going to crush us. Another important scenario is that when the market comes down, it starts to go higher, and then it comes down and grabs that, and then goes to the higher levels. So you should pay attention to these scenarios as well. Another kind of scenario is that when the market comes down, it goes even higher than this high, and then it comes down and grab this and go higher. So these are the scenarios that we can see on charts. Another kind of support and resistance is double tops or QM levels, or what kind of things. We can see these patterns a lot on charts, and people think that it just comes, touches this and goes down, but it has scenarios like this again. So we wait, so this comes to this level and it penetrates this level and then goes to the downside. You can see those trading setups and entry setups in the channel. Let's see this concept on charts. So here is daily chart of euro to US dollar, and we want to talk about the support and resistances. We have a support level here that became resistant, and it has the scenario that it comes up, it reacts to this level, and then it grabs that level, and it is a good trading opportunity here, not here. It is a good move because it is daily move, and it went down for days. Then it came up. We have some kind of support and resistance here, it did the three scenarios with each other. It reacted one time, it is a good move, so it is reliable too. It shifted the market structure even, and we think that it is going to the high, but it went down, it grabbed it, it reacted a little to induce more traders, and it grabbed it, and the movement started from here. When we go to the future, we can see that we have some kind of support and resistance here, and it reacted once, but it came up, grabbed that, and then went to the downside. We have some support and resistance here. You can see that a lot of them fails, and this support and resistance was somehow accurate, but it didn't get touched here. It went down, it came up, it reacted a little bit, but it grabbed it and went down. We have a support and resistance here. It is a good support and resistance for retail traders. They can enter the market after, I don't know, 20 stop losses maybe in these movements, if they think that the support and resistances are exact numbers. So it is another kind of liquidity. I'm going to teach you how to use liquidity points at the end of the video, so watch the video until the end. You can support us with subscribes and likes. It is a very good support for me, and I appreciate that. So at the end of video, I'm going to talk about how you can use these liquidities in your strategies as a bonus for you. Another important kind of liquidity is SMT or smart money traps. Even the most advanced kinds of POIs or trading methods can be liquidity, because the big institutions just want the opposite orders. They don't see if that's stop losses or trailing stops or just stop orders. They just see that it's a lot of opposite orders in that zone, so they try to fill their orders with those orders. So order blocks, rejection blocks, imbalances, breaker blocks, and all kinds of other SMC concepts can be liquidity, and we can use them as our liquidity or POIs for entering the market. For example, here we have an order block here for sure, and another order block here for sure. Even this lower order block has a point of liquidity. But when a smart money trader doesn't know the concept of liquidity, he is just going to bet that this order block is going to work. This is a protected order block, especially it has its own liquidity. But they don't understand why sometimes the order blocks get liquidated and the market starts to go to the upside. But when you know the concept of liquidity, you wait until the confirmation here, and even if the protected order blocks get liquidated, you know that it is a good opportunity. And most of the time these legs are impulsive strong movements. So when you know the concept of liquidity, you don't care if it gets liquidated or it penetrates a zone, or you have, for example, one stop loss in a zone. You most of the time get the good trades. Let's see that on charts. Let's see some smart money traps on charts. You can see that what is a smart money order block? It is an order block that broke the last high. So for example, here we have some kind of order block because we have a BOS, so it is our order block. And you can see that the market came down, grabbed this order block or flip block, and grabbed this order block and just reacted to this imbalance and went upside, because this order block is liquidity. Again, we have some kind of rejection block here, and even we have two order blocks here. But the market don't care about order blocks. It came down, it reacted to another imbalance, and it went to the upside. Even in minor movements, you can see that we have a lot of order blocks here, but it just liquidated the first ones. It reacted to this one, it went to the upside. We have an order block here, Let me show you the exact order block. We have an order block here, but the market don't care about order blocks. It liquidates them and it reacts to this imbalance. It went to the upside, it went to the downside, and we start again. You can see that it went up, it went down, it went up, and we have some kind of a smart money traps here. It went up. It is a smart money trap as well. A person who knows his order flow and his direction isn't going to bet on these order blocks, especially they don't have liquidity grabs or they don't have liquidity after them, so they are liquidity points themselves. Here is a good example. We have a good order block here, but the market came down, grabbed its liquidity, and even didn't touch this order block. It reacted to this imbalance. Here we have another order block. It's like a rejection block. It grabbed it and it went to the upside, and you can see the most of the good order blocks fails because you don't know what is a smart money trap. But now you know that when we have an order block or a protected low, that doesn't change the meaning. When the market comes down, it can liquidate it, it can go to the other order block, or it can just shadow this point, liquidate it, provide you a good opportunity and a good setup that we are going to talk about those setups in the next videos, or we talked about those setups in the videos in the channel, so you can watch them all. So the smart money trap is another important point of liquidity. Another important kind of liquidity is important highs and important lows. So it can grab, for example, this high and goes to the downside, because there are a lot of stop losses here, especially when the market is moving down from here and we have an imbalance here. It is a very important rule. And when we have equal highs or equal lows, it is better point of liquidity. It can grab this and go for this liquidity. But you should pay attention to liquidity points. Liquidity points are fuel of the market, so they can accelerate the market that is moving. For example, it can accelerate this movement to the downside. It doesn't mean it always grabbed this liquidity and went to the upside. So all the things we are teaching and all the things we are talking about are probabilities, but we know the higher probability, and that's our edge. That's when we are a good trader and others aren't, because we know the probability better. And even when we have losses, we are comfortable with them because we know that all of these concepts are probabilities. Let's talk about these equal highs and lows in charts. This chart has good examples of liquidity points as important highs and lows or equal highs and lows. The equal highs and lows can be consecutive highs and lows without imbalances. They can be minor highs and lows or major highs and lows. We can see that here at the start we have equal highs here and equal highs here, and especially it aligned with these old highs. It grabbed this and it provided us with a good move. It is a good move because it's 1 hour time frame. I use mostly 5 minutes and 1 minute to enter the market, so it is a good movement for me. Anyway, so here we have some points of liquidity, and here was liquidity as well. And here we have this point and this point and this point. So it can come down and grab this liquidity and react to this order block or imbalance. I use imbalances for entering the market and finding POIs, not order blocks. I don't believe in order blocks. And you can see that it is some smart money trap we talked about. This high came, liquidated all these highs, and it went to the downside. It came down, it grabbed this liquidity and it went to the upside. This high grabbed this important high. So important highs and lows are liquidity points. it came down, it grabbed all these lows and it started to go to the upside. We have equal highs here. We have 4 relative equal highs here, even 5. So it grabbed this, it went to the downside, it grabbed this important low, went to the upside, and it grabbed this equal highs and it went to the downside. So all the equal highs and equal lows can provide us with entries, but we don't pay attention to all of them because it's probability. They sometimes fail. We use confluences. For example, if we want to try this trade here, we go to the left of the chart and see if there is a good level or if there is some kind of imbalances, and especially you can see the right of chart as well. It is a good round number, so you can use any kind of confluences. You can use moving averages. For example, you have some kind of moving average that is moving in this direction, so when we have confluences from liquidity points and the moving average and the imbalance, it is a good trade. So you can find and use any kind of confluences you like, but always use confluences for trading. We are using confluences. We are using confluence of liquidity points and imbalances in simple terms right here. When I'm talking about liquidities, you can see that I'm using confluences. I'm using all the smart money concepts like imbalances and order blocks plus liquidity points, or I'm using the smart money trap plus imbalances. I'm using liquidity points plus round numbers. So you should do that. Again, it increases your win rate, it increases your accuracy and probability. So the equal highs and lows, or relative equal highs and lows, and all the consecutive highs and lows are points of liquidity. For example, all these consecutive highs and lows are liquidity points. When we have so many consecutive highs and lows, for example here or here, lower, higher low, higher low, higher low, higher low, higher low. When we have something like these kinds of concepts, we come to something named trend line liquidity or order flow liquidity. So it is a kind of order flow liquidity. It's when the market is boop, 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 boop. It is printing a lot of liquidity points and higher lows or lower highs. So when the market comes to grab these liquidity points, we pay attention to imbalances and we pay attention to these kinds of higher lows, for example. So for example, sometimes it grabs some of them and reacts to a round number or an imbalance and starts to go higher, but most of the time it grabs all this liquidity with a sharp movement and then, for example, retraces and it can continue its down move or its up move. It is trend line liquidity or order flow liquidity. For example, here we have order flow liquidity plus here, and you can see that the market, boom, it grabs this liquidity. Again, we have some kind of important order flow liquidity here. You can see that here we have some order flow liquidity down here, but because we have an important level and an important imbalance and an important number here, it reacts to this number. But we have some kind of order flow liquidity, it grabs and it goes to the upsides. We have some kind of order flow liquidity and boom, and these can help us and provide us with very sharp movements. It is a little hard to grab this movement, but it works the try. For example, you can see that here we have a lot of order flow liquidity, and look at this movement. It's massive, explosive, and it's very fast. Why? Because it's the order flow liquidity that provides us with these movements. Or we have a lot of order flow liquidity here, and we can see that it is a good movement. We have a lot of order flow liquidity here, and we can see that it's a sharp movement. So the sharp movements most of the time happens after some kind of order flow liquidity. We have some concentrated order flow liquidity and you can see the movement. The order flow liquidity is a little bit hard, but you can try to use them as some kind of narrative you have in your mind. For example, the market is here and you have a lot of liquidity here, you have a rejection block here, and if the movement has started, you can see that. So it is at least it's grabbing some of this liquidity. It can react to this imbalance or this imbalance. You can see that how important are imbalances. That's why I just use imbalances as my POIs. Yes, we have a lot of liquidity points and liquidity types. Don't mix them up. Just try to watch this video again and again and again, and when you go on charts, just use the points of liquidity and the kinds of liquidity that you can see yourself on charts. Don't push it. The market is the most aggressive beast you can see in the world, so don't push anything. When you for example you can't understand these kinds of liquidities here, but the market is going up, you can understand this point of liquidity, you mark it up, but you see that the market starts to move up again and doesn't react to this liquidity and doesn't come back. It's okay, you can go up and mark this point and this point again, but this time it provides you with a good movement. Then you don't understand why these kinds of things happen or why this trade happens, because it has a lot of liquidity here, but you can see some kind of easy liquidity like here, and you can see that we have an order block here, it came down, it reacted to this order block, and it is a good trade. You may say that it is an order block here, and I said that I don't use order blocks, and that's right, I use lying shadows. Lying shadows are some kind of imbalance as well. If I go to lower time frame, 15 minutes, 5 minutes, you can see the imbalance here, and the market starts to react to these kinds of concepts. Let me show you what is experience and what is fake guru. It was 1 hour, right? I found that it is our box, and you can see this lying shadow is imbalance and order block itself, and you can see the reaction. So it is experience. Anyway, so you go watch this video again and again, and then you go on charts and you try to mark every POI that you are comfortable with, and you mark the liquidity points that you are comfortable with again. Another important thing is that we are going to continue our lead course for free. So we are going to talk about, for example, some episodes about just time frame liquidities like monthly, weekly, and daily highs and lows. Or we are going to talk about sessions liquidity a lot in this challenge. So don't worry, I'm your trading companion and I'm here. I have some kind of custom script to use for my sessions, but you can go and you can add Asian range by Nico in indicators. Asian range by Nico, this one, and you add that. You can add 3 of Asian ranges because we have 3 sessions, and the setting for Asian range is 19 to 0 in the morning. I mean 19 o'clock to 0 o'clock in the morning. The London session is 2 to 4 or 5 a.m. and the New York good hours is about 8 to 10 or 11 in the morning, and you should use the New York time for your trading view. So first you add the New York time and you use those settings I said. I don't use Nico. I have my own script So what are the sessions? I should first talk about the AMD itself. What is AMD? AMD is a pattern, is a simple view of one of Wyckoff's schematics, and it's like this. The market is ranging or accumulating the orders. It comes up and it grab this liquidity, or it is the manipulation phase. So we have accumulation phase, manipulation phase, and then it comes up and we have our distribution phase. But in the distribution phase we have some kind of reaccumulation again here. So we have two phases of accumulation in sessions, in market, in everything you can see in the market. We have accumulation phase and they are accumulating orders, and it is legit because all the institutions should accumulate their orders before the London or before the New York session. The orders go to those exchanges before morning. I mean the big orders, the orders that are enormous. The normal amount of orders that retail traders do or some big traders do, yes, they go in the sessions, but before the sessions is the time that the big orders go. So we have accumulation session, or it is Asian session. So Asian session is accumulation, manipulation is London session. It comes up, grab the Asian's liquidity, it goes down, and we have the accumulation of New York session as London session itself, because sometimes London is ranging and New York grabs its liquidity, but most of the time the London makes an correction move that you think it is a buy for New York, but it is a fake move. The New York comes, grab it, and goes in the direction of the London session. So we have another accumulation in the middle of the New York session. It is very important. You can't find these kinds of concepts in any other courses. Let's just see the session and see how they work together. Excuse me. Let's start from here. It's because it is a very big move, and sometimes the high of the Asian session gets protected, and we can see that here. We have Asian session here. You can see that here. We have the London session grabbing its liquidity. It went up. We have New York session. It accumulated the orders. Let me show you here. It accumulated the orders in the New York session open. It grabbed it, so it manipulated it again and it distributed it. Again, let's go to the Asian session. Asian session this time is trending, so it is itself a distribution. But anyway, the London session came, it grabbed its high, and it provided us with a trade. It is not a good London session. I trade this high, and it is a very profitable trade. I can go and you see, if the trading you give me the data, I can go and show you in 1 minute time frame. I talked about my entries in the videos, and you can see that here. It is my entry here, right above this high, and you can see that it is a very good trade. And I put my stop loss on the candle that made this imbalance. You can see the results. It's 5 or 6 to 1 reward to risk ratio. I talked about these concepts in the channel. I talked about my entries in the channel, and it's no scamming things up. I talked about all of these concepts in the channel. So I found it again. Let's see what happens here. And the London started to go higher, and you can see the accumulation and manipulation phase here. It is accumulation phase and it is the manipulation. It came down, it grabbed this low, it reacted to this imbalance, and it went up. It is the New York session. We have the Asian session here. I know that your mind is blowing. These concepts come from experience. it came down, it grabbed the low of the Asian session, it went up in the London session. And in the New York session, it is a little late in New York session, but anyway, it is in New York session. It came down, it grabbed these liquidities, reacted to this line shadow I talked about, and went up. I'm sorry, it is the Asian session, grabbed the low in the London, it went to the upside. It is a little bit different because the New York is trending and it didn't grab London's liquidity. The Asian session here is important because it grabbed the inducement of this kind of inducement that I'm going to talk about in this channel. It went to the downside. The London session manipulated these highs. It didn't manipulate the high of the Asian session, but it manipulated two important highs. It went to the downside, and New York session worked as I said. Sometimes it is surprising for myself as well when I'm summarizing things up or I'm creating these videos. These concepts are so powerful that I sometimes get surprised and get hyped with these concepts. This day is just trending. It's because of the news. Let's see what happened in the next day. The next day it is Asian. The Asian manipulated itself, I think, or maybe let's see what happens here in lower time frames. Maybe it is, for example, 1 minute or 2 minutes that. No, I think it just went up. Yes, it just went up anyway. Let's see what happened. And it is the London session. London session grabbed the high of the last day and grabbed the high of the Asian session. It started to go to the downside. New York comes and react to this point or grab this point and goes up. Let's see what happens in the New York. It grabbed this low and it went up. Let's see the next day. I'm sorry for low internet connection. We are in an internet blackout, so you can help me with subscribing and liking. Today it is a better internet connection, but they are making us like North Korea and we can't do anything about it. So your help, your subscription, your support can help me survive these dark times. We are in an internet blackout. Anyway, we have Asian session and the Frankfurt grabbed its low. The London grabbed the high of Frankfurt and these important highs, and it manipulated the market. But another important thing is that these highs are important, so I think the London is going to go to the upside. No, it didn't. It's all probability and I'm okay with that. It went to the downside. New York came up and grabbed this liquidity. So you can see that these kinds of liquidities work like magic. Let's talk about the last part of this video. We have two important things to talk about right now. First is the AMD pattern that is important for us because it comes down, it grabs this liquidity, it goes up, it reaccumulates and it goes upper. It is a very important schematic for us because all of the liquidity concepts comes from this schematic. It is the simple form of the Wyckoff schematic and you can see that here. What happens here? We have the accumulation phase here at the start of the trend. The market comes down, manipulate this low and test this low at the same time. What I mean? First it comes down and it tests the sellers. Do sellers want to go lower, or are sellers committed to push the market down or not? So the first concept is testing these lows. And the second concept is that they are absorbing the sellers and making them to buyers. So they are absorbing those orders and manipulating the sellers and they are buying the market. The market starts to push up. Another important thing is that it is a distribution phase, but we have some kind of reaccumulation in the trend. So we have another accumulation phase. It can be ranging or it can be just a single low. It can be a double bottom. It can be anything, but it is the next point of accumulation, and we call that reaccumulation. The market comes, grab this, and goes to the upside. It doesn't just happen in session, it always happens in all the markets. So we just keep this simple here. Just make your brain absorb this schematic. We are going to talk about these concepts a lot in the next videos of Lead playlist. Now let's talk about liquidity in the nutshell and how we can use that liquidity. We talked about what is liquidity and what are liquidity types, and we saw its action on charts, but how we can use that in our trading plans and trading strategies. Because most of the gurus out there, they are just talking about liquidities. It is a liquidity point. So what? It is a liquidity point, and I know that. But how I can use that systematically in my trading plan? For example, here I didn't see the lower time frames on this one, so it may not be the exact setup I am looking for. Anyway, here we have a point of liquidity, and it is a good liquidity because we have order blocks and imbalances below that, and it came down, it grabbed this liquidity, and it went upward. I use 5-minute time frames to enter the market when I have a liquidity grab of 4-hour time frame, and the market is very bullish. So we look for buying trades. First is we use this as our confluences and POI. So when I mark this on my chart, and for example I am looking what is happening after that point, it is a POI for me. I may not mark my POIs because I know that what is happening, it is going to happen after this point of liquidity, but you can mark your POIs as well. So first thing is that we use that as confluences. For example, we don't mark just this liquidity and this order block because it doesn't have liquidity confluence in it. So we mark this liquidity point for confluence to this order block and imbalance. The second thing is that it is some kind of POI buffer. It increases the probability of that POI that we are looking at. For example, here again, this liquidity point is increasing the probability of this POI, and this liquidity point is the exact same like this one, but this didn't work because it didn't have a good liquidity point. But when we use this as POI buffer, we can see that it came down, it grabbed this, and it is reacting to this one. We may have time frame liquidity. We have some kind of daily liquidity here. It grabbed this candle's low, and it hit our support and resistance of daily here. And in 5 minutes, we can see that it came down, it grabbed these liquidities that we pointed out in the past, it shifted to the upside. And the important thing is that we use liquidity to enter the market. For example, I don't think I'm entering the market here because I look for confluences with liquidity. I am going to enter the market here because I have my liquidity points here, I have my imbalance here, so it is a good opportunity. Or you can wait. If you don't know how does this work, you can see the videos of the channel. I talked about this setup in the past. You can wait until the market prints some liquidity points like Asian low, and these lows, it comes down, it grabs it in the London session, and you can enter the market right here. So it's up to you to how to use that liquidity pools. Let's talk about another opportunity. If we want to look at the market like live trading, I have this POI, and importantly I have this one. So it is my liquidity point. So I'm going to clean this up because we are talking about liquidities in this episode. And you can see that it is a little bit tricky. You may have some stop losses here, but the market is too bullish. But you can see that here again. Let's see if we have a stop loss here or not. I'm not afraid of stop losses. We may have some kind of stop losses. The market didn't shift here because our important point is here. Maybe we can say that this market shifted here, and for example I enter on this POI. It is Asian session. I don't enter, but I will enter on this POI or on this POI. Why I am using these kinds of POIs? Because it has liquidity before that. It has this liquidity. So this is a good POI, and we may have a stop loss here. If it provides me with 4, I'm good. No, we may have a stop loss here. You are going to have a lot of stop losses in your trading, so don't be afraid to risk your money in the good POIs with good setups. But when we go to this POI, we can see what is happening here. How I am going to enter the market? First, I am going to watch this POI. Watch this POI. It is Asian session, so I'll wait, but the best entry point was here. But after the Asian session, what I do? I wait until the London session comes and grab these highs. After that, you can do two things. First, enter right here on this candle, and you can, for example, enter above this high or above these highs and put your stop loss a little higher than this. Or this long shadow candle is good enough, so you can enter the market here for this stop loss, and it is a good trade. But what I do, I will enter the market above this high because I need imbalances in my trading plan. So it is my trade. The New York came up, grabbed this liquidity, and you can see the results, and I'm already in the profit to my neck. So it is how we use liquidities as buffers in our trading plans and as POIs, as entry points. So first we should mark our liquidity points as POI buffers or as POIs itself. Then we go to lower time frame and we look for liquidities again. Thank you for watching this video. This course will continue. I have a very low internet connection, very low speed internet connection, so I'm sorry if I'm not consistently providing you with these videos, but you can see that how profound and how deep these videos are. You are going to be okay using these concepts, but the market do pay for responsible people. You should take these trades, you should use these concepts with your responsibility. It is not me that clicking in the market, so you should have a deep understanding of these concepts. You should train and practice with these concepts for a long time, and after that you can practice these concepts on demos, and after that you can practice these concepts with a live account with your responsibility. We are in a dark time here. We are in an internet blackout. Your helps and your supports is much appreciated. So commenting if you have a question, or if you have a positive comment, or if even you have a negative comment, it is a great help for me. First, I can improve contents with your comments, and second, you are helping me with your kind comments. And make sure to subscribe to our Telegram channel. I provide you with free PDFs and free markups every day. The markups are every day for sure. And you can DM my private account for private 1v1 webinars and mentorship in a long term. I mean yearly or 6 months mentorship, because my focus is you to make profits in this market. So I am not with other gurus that they are trying to teach you in 4-hour webinar or in 3 days boot camps. I am going to be with you for 6 months or a year, and that's very cheap because we have a lot of inflation in my country, and that is a good support for me. Thank you and for watching the video. Pay attention to playlists. There are a lot of good videos like this, and goodbye.